What's up, everybody? Dan again, Stocktrades.ca. Welcome back to the Stocktrades YouTube channel. We're going to be going over something a little different and something that has been widely requested by Stocktrades YouTube subscribers, and that is to get to know my exact investing strategy, what my strategy has been over the last 5 years, over the last 10 years, and they also want to know how I structure my portfolio to outperform today, what I have a laser focus on in the markets today, and they also want to know why I don't publicly release my portfolio, except for the most part, Stocktrades premium subscribers. And they also want to know how I navigated the 2020 market, especially the 2020 crash, as a growth investor. So I'm not sure how long this video is going to run on for, but I am going to go into my overall investment strategy. I'm going to go into what I am going to be doing moving forward, my total portfolio makeup, and I'll also, at the end of the video, I'll give you my top 5 holdings within my portfolio. And considering my performance over the last, half decade, you will actually be very surprised at what my top 5 holdings are. So with that being said, let's get started. So before we get started, smash that like button and head down below, subscribe to the channel. It really helps us out and we love the support. So first off, I'd like to explain how my whole portfolio is made up. So in the sense of tax-free savings, RRSP, taxable accounts, Lira, I am 100% invested in equities and ETFs. And in terms of my stocks, I am 100% invested into Canadian stocks. Now, in terms of international diversification, I utilize ETFs to hit that for me. I really think it is a very poor idea to be laser focused on a single country and get somewhat of a hometown bias. So although my stocks are 100% Canadian, I have some ETFs that provide me with the broad diversification that I need. More on that a little later, as well as I talk about my overall strategy. So this is in my investment accounts per se, but my portfolio is not 100% equities, and that is because I do own rental property. It's a passive income stream for me. I purchased my first home when I was around 21 years old. It was just a small townhome that I still do own to this day and have rented out for quite some time. So I built up a 6-figure equity position in that, and I also have my primary residence as well, but I don't really count that towards my overall investment portfolio. The only thing I do count is my rental property. So 100% stocks and ETFs on the investment account side, but I do have some real estate exposure, which is exactly why I do not hold real estate investment trusts. So how is my strategic allocation in that 100% equity portfolio organized? The bulk of my portfolio is invested in Canadian dividend growth stocks. Now, did I go growth heavy in 2020? Absolutely I did, but the reasonings for this actually shifted identical to my overall investment strategy that I have deployed over the last 5 to 7 years when I shifted from a 100% dividend growth investor to a hybrid, more aggressive approach in 60% dividend growth and 40% pure growth. So there's been a few massive investments I've made in terms of growth stocks over the years, including, Shopify in the mid $150 range. And I had something like Canopy Growth that I bought at $9. A lot of people think that once you buy these stocks, you're locked in for life. You can't sell them. So essentially it's all unrealized gains, but I am consistently balancing these on an annual basis. But a lot of people have been asking me how I maintain this balance during the crash of 2020. We'll get to a bit how my portfolio reacted overall, but it's safe to say that my growth allocation went from 40% to significantly lower than that, and my DGI ballooned because those types of stocks held on better. So what exactly did I do? I fed some new capital into my account and I upped that growth portion back to 40%. So as I was doing this, my DGI was decreasing, my growth was increasing, and I held on to that 60-40 allocation because that is my plan. That is my overall investment strategy. And as a result, I ended up nearly tripling my portfolio off those lows. And it's not like I'm buying, speculative penny stocks here. I'm actually buying strong companies, and I was able to outperform significantly in 2020 because growth was a massive popular option, and I let my portfolio essentially overheat, and I allowed the overall drift of my growth allocation to go way higher than 40%. But to enter 2021, I rebalanced. I ended up selling a ton of Lightspeed shares off. I still do own the company, but I took a ton of profits, and I took a ton of profits from other growth companies as well, and again, fed them back into that dividend growth investing portfolio. And as we move forward in 2021, my portfolio is touching all-time highs, and my growth allocation is actually getting a little bit lower because my dividend growth portfolio, especially because it is heavily invested into Canadian dividend growth stocks, including financial stocks, is taking over. It's got a heavier allocation, and as a result, my portfolio is currently touching all-time highs in 2021 because there's positive momentum in the sector. Now, will this continue moving throughout the year? Probably. It's very likely that reopening stocks, real economy stocks as they call them, will continue to outperform, and I will benefit from this and likely beat the markets again in 2021. This is my overall investment strategy. I've deployed it for a long time now. I made the switch primarily actually when we first started Stocktrades, when we first started the blog. I became, fascinated by growth investing, and one of the primary reasons why is this chart right here. So when I first started out, especially post-financial crisis, I wanted to be a value investor. Warren Buffett, I had read the books, I had security analysis, The Intelligent Investor. I wanted to be exactly like that. But I actually did end up reading a piece, I can't remember what journal it was from, but they had stated that, this is going to be the decade for growth investing. Interest rates are at extreme lows. These companies are going to be able to thrive in this new environment. And it is a situation where if you're in value or if you're in income, you will likely underperform. At first, I didn't listen to them. I maintained a 100% dividend growth portfolio. At the time, I essentially was all in Canadian dividend growth stocks. And then again, I utilized ETFs to give me my international exposure. But, in 2016, I saw this comparison, this MSCI USA Value and MSCI USA Growth, which are indexes that track both the value and growth companies in the United States. And I saw the outperformance back then. And as a result, I transitioned to this 60-40 model, which I have ran ever since. As we can see, since the mid-1990s, and especially when we get to post-financial crisis, the environment for growth companies has been absolutely absurd. They've been able to borrow for record low levels. And as a result, you can see that, since the early 1990s, US growth stocks have outperformed value stocks by more than 3 times. You probably wondered, okay, I know your strategy, but how has it performed? So if we look to the overall returns here, and these are directly from Qtrade over the last 5 years, I have an annualized return on all of my accounts. This would be my LIRA, my RSP, my TFSA taxable account of 37.61%. So in terms of actual dollar figures wise, if you want to understand what that is, if we were to go to an investment calculator and you were to have invested $10,000 after 5 years with a 37% annualized return, that $10,000 would be nearly $50,000, $48,261. Now, do I expect these types of returns to continue? Absolutely not. And if you're achieving these types of returns, you should not expect them to continue moving forward in the future. So Overall, moving forward, it's very rare that I do make exceptions. I'm going to continue to deploy the exact same strategy. I'm going to run a 60 dividend growth, 40 growth moving forward, unless my allocations get way out of whack, like in the event of another stock market crash. Then I might find that I will rebalance at that time to take advantage of depressed prices elsewhere. Now, the next question that I get asked a lot is people want me to release my portfolio. Now, why do I not publicly release my portfolio? Now, there is a few reasons for this. One of them being the vast majority of my portfolio, what I run with, is available to Stocktrades premium members. In fact, around 95% of the holdings within my portfolio are researched, presented, and constantly monitored to premium members. But the second and arguably the most important reason is the fact that I carry a very aggressive type of approach. Not very many people can even handle a 100% equity-based portfolio. Not to mention a 100% equity-based portfolio that includes 40% pure growth plays, or at least growth plays that do not prioritize the dividend. My max drawdown during the March crash of 2020 was significant. I lost, it was, I believe, over 40% of my portfolio in less than 3 weeks. Now, there is not a lot of investors who could handle this type of volatility at all. So as a result, I do not publicly display my portfolio. I don't even post my overall allocations to Stocktrades premium members. I disclose the stocks that I own, but my own strategy is my own strategy, and it is absolutely critical that you develop your own strategy besides searching out YouTube videos trying to mimic portfolios, because all this will do will run you into a whole heap of trouble. So we're nearing the end of the video here, and I did promise that I would release my top 5 holdings. Now, for a portfolio that has had the gains that it has, you probably wonder why these would be my top 5 holdings. So these top 5 holdings might give you an idea of why, despite being a very heavy growth investor, why I'm still outperforming in 2021. Now, my top holding right now is TFI International. It is actually the only stock inside of my portfolio that does have a double-digit weighting. I really like this company. I had loaded up on them in the pandemic, and I didn't balance them in full. I felt pretty comfortable going overweight on the company, and I actually really like them moving forward. And the UPS Freight acquisition actually made me keep this company as one of my major holdings. And keep in mind, actually, I'm only speaking on the stocks. XAW makes up a massive portion of my portfolio. It's essentially how I get broad exposure outside of Canada. My second biggest holding would be BMO, the Bank of Montreal. They have a high single-digit weighting. I really like this bank. It was one of our Stocktrades premium calls on our dividend bull list, and it has been essentially the best performing bank. It struggled in early 2020, but after that has been an absolute rock star for my portfolio, and I pretty much can't wait until they can raise dividends again. Third biggest holding would be TELUS. In my eyes, it's one of the best telecom companies in the country. A lot of people like BCE because of their income. I don't blame you, but TELUS as a all-in-one, rolled up telecom company that doesn't have, the large overhead and the low margin media businesses. They just strictly focus on, telehealth, cell phones, security, stuff that I really think is going to grow at a more rapid clip. So fourth largest holding is the Royal Bank of Canada. This has been one of the longest stocks of my portfolio. I've held this stock for a very long time, and it contains a mid single digit weighting in my portfolio. This was an absolute rock for me during the COVID crash. This is a bank that has so much global exposure that it essentially was exposed to a bunch of economies that were recovering at different periods of time. So it really helped it thrive. And as of right now, in order for the Royal Bank, this is actually a very interesting piece that I read, they maintain typically on average a 50% payout ratio. So they could raise the dividend by 30% this year if they hit 2021 estimates and still maintain that payout ratio. This is critical. It just shows you how well capitalized these banks are and how poised they are to outperform. My third largest holding right now is actually Toronto Dominion Bank. Again, they have a mid single digit weighting inside of my portfolio, and again, it's one of those stocks that I own that I think is going to benefit from the United States getting back to normal. Toronto Dominion Bank has a lot of exposure south of the border, and they're a bank that struggled quite a bit during the COVID crash. So there's my top 5 holdings. You can probably tell that I am pretty bullish on Canada's banks. They've ran up a lot in 2021. If this was in January when I had rebalanced, you wouldn't see 3 of these 5 banks in my top 5 holdings, but because their prices have appreciated so much, they do end up there. So overall, I'm a pretty aggressive growth investor. I run a very heavy growth portfolio, and my top 5 holdings still pretty much comprise of 4 Canadian blue chips, Intellis, BMO, TD, and Royal Bank, and a trucking and logistics company in TFII. I'm a very firm believer that you need to build a solid foundation inside of your portfolio. Not every single stock needs to be filled with flash. You need stocks that will perform during the good times and during the bad times. There are a ton of people who went way overweight on growth, and they might have even been trading on margin back in February, and as a result, they have been absolutely steamrolled when it comes to their portfolio. And I hope this is a mistake that they will only make once. So everybody, that's it for the video. I really hope you liked it. Quick recap, I am primarily a DGI, a dividend growth investor. But my 40% growth portfolio, where I pinpoint and laser focus on Canadian small to mid cap stocks, has allowed me to accelerate my gains over the last half decade since I switched exponentially. You need a solid core inside of your portfolio. You cannot go too heavy on growth, or else you will simply be crushed in times, like February, in times like the COVID crash, or you will at least be put in a situation where you are very, very uncomfortable about your financial future. I don't release my portfolio because I am such an aggressive investor, and I do not want beginners or people who simply want to mimic my portfolio to copy me. This is not the way we work. This is not the way we advocate people investing. You need to figure out your own risk tolerance. You need to figure out what works for you, and we are currently helping thousands of premium investors figure that exact thing out. So if you do want to join Stocktrades Premium, and I can't stress enough, this is the best platform in the country. Pinpointed Canadian small to mid cap stocks, dividend growth stocks, and of course foundational stocks to help you build your core. My portfolio, the bulk of my portfolio, I would say 95% of it is comprised of these stocks. After we highlight them to members, I'm hopping on board and buying them as well. So if you're interested, link in the description below. And overall, subscribe to the channel, smash that like button, and we'll see you next time.